Hello, everybody, and welcome back. After 2 hot years, technology stocks have recently cooled down noticeably. But the next big technology trends are already poised to change society and the economy. Today, we talk about this and more with Denny Fish. Denny is a portfolio manager at Janus Henderson Investors, responsible for managing the global technology and innovation strategy. A warm welcome, Denny.
Thank you for having me.
The layoffs of Facebook, Twitter, Amazon have highlighted the limits of tech companies. So has the growth at any cost paradigm already shifted away?
If we look back the last 3 or 4 years, the first half of that, technology companies, as you mentioned before, were in very hyper growth mode. And frankly, they were in a war for talent as well. And the last year and a half or so has given them the opportunity to actually normalize their businesses. These are highly profitable companies. They're companies that still are structural growth companies. And yes, I'd say growth at all costs is probably behind us, and that's healthy for the industry in general.
The economies in developed countries are not running smoothly. There are signs of a global recession. So how does a global economic downturn affect tech stocks?
Yeah, it affects tech stocks in a couple of ways. It's interesting because this has been a self-induced downturn, given the rise in rates to combat inflation. Rising rates are generally not a friend for growth equities. Therefore, you've seen multiples actually compress, over the last year and a half or so. But what I will say is with the normalization in rates that we're seeing now, you've seen a much better response to really good financial performance for the tech sector during 2023. And importantly, if we go back through just about every recession over time, when we've been in an environment where there has been technological change at a platform level that's occurring, what it's done is it's really shifted the sands pretty aggressively and put kind of a new group of leaders in place to embrace that technology as we get through the recession, as companies are much more efficient with the money that they're spending, and has actually led to accelerated growth in certain categories on the other side. So we're actually pretty optimistic about where we sit right now. And then the other element is that technology tends to grow multiples of the market in terms of both growth rate and returns on capital. And they, in some cases, we're seeing it right now, while the economic storm clouds are dark, you've seen tech actually perform particularly well in 2023 into the face of that. And that's been across semiconductors, software, and the digital ad ecosystem.
The China-US decoupling or de-risking has entered the next phase with the chip ban. So how does this change the environment for technology companies?
I think it's actually a really interesting time. And what I mean by that is, while the tensions between the US and China are significant, what it has led to, so, it's the combination of China tensions and the combination of the pandemic that we just went through that led to severe supply chain constraints. And why that's important is as we shape the next 10 to 15 years globally, just about every major continent wants to have a self-sustaining semiconductor industry. Semiconductors are the most important elements for global economic growth over the next decade. They enable technology, they enable productivity, and you can't buy a dishwasher without semiconductors at this point in time. And everyone learned that the hard way during the pandemic. And so we're going to see, and we continue to see, subsidies out of the US, out of Europe, out of Japan, out of Korea, out of India, and other geos to build a self-sustaining semiconductor industry. And so that's really good for semiconductor capital equipment, given the nature of those businesses. They're really five globally that actually are the most important vendors that operate in narrow monopolies to be able to provide that. And then you have the foundries like the TSMCs of the world that are building out global shells in many other geographies around the world. So I actually think it's a really exciting time to be an investor in particularly the semiconductor landscape.
So you mentioned the pandemic. So gains in the S&P 500 from 2020 to 2022 came mostly from big tech. So how attractive are US big techs after the recent correction?
Yeah, well, we had the correction through 2022, which was healthy in terms of where valuations went to. Entering 2023, valuations were in a much more favorable spot. And so, despite weakening fundamentals on the margin, you've actually seen the stocks perform well because of the starting point coming into 2022 and the market starting to discount what growth might look like on the other side of recession, given some of these tailwinds that we, continued tailwinds from things like cloud, but then now this, additional tailwind that can be very impactful over, the next many years, which is the deployment of artificial intelligence through the broader economy.
The chip shortage seems to have been overcome. So what's next for semiconductor suppliers? Will overcapacity be the next threat, or will demand continue to rise due to new technologies and new applications?
Yeah, so it's a little bit of both. Anytime the economy softens, semiconductors are going to soften with that because they're a proxy for GDP growth. But the reality is semiconductors grow at a multiple of GDP, and content continues to grow faster on a per unit basis for finished product. And what I mean by that is if we think about, I mentioned dishwashers and appliances, but maybe the most pronounced example of where this takes hold is in the automotive industry, where as we move from gas-powered vehicles, internal combustion engines to electric vehicles, the semiconductor content in those cars goes up about 5 to 7x relative to a traditional vehicle. And so while you'll have economic softness in terms of industrial and auto and these general end markets, the content growth will continue to be quite strong through the cycle. And so that should help to damplify or to dampen some of the amplitude of the downturn. And then we're already through, the worst parts of the PC correction, smartphone correction, and now servers, as hyperscalers digest some of their traditional CPU buying. So it's kind of like the leading edge stuff. The worst is behind us, it feels like. The more analog stuff that is in, the everyday things that you use, probably still more softness on the come, but the downside should be protected given all these secular content drivers.
We are experiencing innovations in a wide variety of areas. So which industry and developments do you think are the most exciting ones at the moment from an investor perspective?
I think clearly artificial intelligence, generative artificial intelligence in particular, as we've taken that next step with the deployment of ChatGPT this past November. And why this is important is the potential for productivity gains in the economy is probably at a level that we haven't seen since the advent of cloud computing. And it has the potential to be even more impactful because we've already laid the foundation for the last 20 years with the internet, with mobile, and with cloud computing. So the world sort of has this access to infinite amounts of compute. The technology for large language models has evolved in an amazing way to the point that we can marry this access to compute in the cloud with these large language models and train them at levels that we just couldn't imagine possible even 3 or 4 years ago. And, that has really significant implications for the type of applications that we can then deploy, the way that we can use data, the way that companies can leverage their proprietary data to provide really unique and novel solutions to their customers. And, as I mentioned, just this general productivity boost that we could potentially see across many different industries.
So you mentioned AI, ChatGPT and others have unleashed a new hype around machine learning and AI. So shares like NVIDIA have literally exploded as a result now with a 1 trillion plus market capitalization. To what extent does this topic offer real investment opportunities to investors?
Yeah, so I think there are going to be a lot of opportunities. Right now, the market is fixated on the obvious opportunities. And clearly, the most obvious opportunity is investing in the market leader for GPUs, because none of this happens without training on GPUs. We're probably in the most significant supply demand shortage for any type of semiconductor component ever. And, that was really exemplified by this latest quarter that NVIDIA reported. There are many, many derivative plays that we're going to see in terms of being able to invest in AI, and whether that is, the large cloud platform providers that are providing these large language models, either to consumers or businesses, the ability for software as a service companies to take their proprietary data sets and train against those and provide really unique solutions. Clearly, semiconductor infrastructure with GPUs, it's not just going to be limited to NVIDIA. By the way, none of this happens without semiconductor capital equipment. So that's it's a really good secular driver. Things like ASML, in Europe with EUV lithography. The foundries, GPUs, they only right now get produced at TSMC. So without TSMC, without semiconductor capital equipment, the GPUs can't even get to customers. So there are many, many ways to think about where this could layer on. And then there are the really non-obvious ways to invest in generative AI. And that is, are there industries or are there companies that historically been kind of worst in class at providing certain types of services because it's really expensive to provide those services and it's not a great experience? And could generative AI actually improve the experience and reduce the cost and the labor associated with it materially? So those are some things that we're looking at too. And then you think about areas like agriculture and being able to be much more precise with the way that we grow and harvest crops and just get yields globally, with food, being such a critical resource. There's just a lot of ways that, we should be able to enhance that over time and really do good for the global economy as well.
This was Denny Fish, portfolio manager at Janus Henderson Investors. Thank you very much, Denny, for being with us today and sharing your insights into the latest developments into technology investing.
Absolutely. Great. Thanks for having me.